Welcome to another episode of Beyond the Mortgage. I'm your host, Tracy Valko, and I'm excited for today's guest, Mark Hart, who is the co-founder and owner of Encompass Financial Group. Mark has over 25 years of experience in the commercial lending spectrum, not only here in Canada, but in the U.S. as well. He's held leadership roles as Senior Vice President of CIBC and has managed over one of the largest commercial portfolios in Canada of $8 billion. Mark's going to dive into his leadership skills and his expertise in the commercial space. Welcome, Mark, to Beyond the Mortgage episode. I cannot believe that I finally got you here. I know you're such a busy guy and have such a great story on your business and really the foundation of what you opened up with Encompass Financial Inc. You are probably, in my opinion, and I know in many people's opinion in my industry, you are the icon in terms of knowledge and education in the commercial landscape and have helped a lot of brokers across the country. I want to really dive into, and I always like to do this, is in the grassroots of how this whole idea and concept and how you came to open up Encompass Financial and where that came from.
First of all, thanks for having me. It's great to be here. A big fan of what you do, both here on Beyond the Mortgage and also in your daily job, if you will. So started off as a residential mortgage broker back in the 80s. It tells you a little bit about my vintage, and migrated over to the commercial side over time. Started off, as I said, in the brokerage business, got my license in the late 80s, 88, 89, and ended up on the institutional side in the mid-90s, and then lived in the U.S., but ultimately came back to Canada, but ultimately came back to the brokerage business after I left the bank in 2012. It's interesting, once you worked in the brokerage business and went out, worked for a number of different institutions, acquired a lot of unique knowledge, and then have the opportunity to come back to the brokerage business with a completely different perspective. It's been a journey, and so decided to come back to the DLC mortgage center world where I started, frankly. And even where I started was interesting because I went from a residential broker to work for Mortgage Center when they first started, ran a bunch of the mortgage operations across Canada, and then left and then came back. So had a brokerage corporate job, started off as an individual broker, took a broker corporate job, and then came back to owning a franchise. It's been a journey, but we really enjoy supporting a lot of the brokers. Probably about 80% of our business comes from the Tracy Valkos of the world, if you will. So we enjoy supporting our residential broker partners on commercial referrals, and it's just a really interesting world. We see a lot of interesting business. I know we're going to maybe get into some of that stuff from some of your questions, but there's not much that we haven't seen in terms of commercial deals. It's a very big market. A lot of people are looking to invest in commercial real estate and commercial mortgages. So it's a growth area for sure.
And I know before the podcast, you and I had a lengthy conversation in terms of, where you grew up and where life took you. And I know that you worked in the financial industry, not only here in Canada, but in the US as well. And I really want to go back even before that because you are I'm in Kitchener-Waterloo. I wasn't born here, but I feel like I have been here all my life. My grandparents were here and we would always come back every summer. And then for the last 30 years, I've lived in Kitchener-Waterloo. And I knew that you grew up in Kitchener. What was that like for you? And you've had such an extensive experience, not only here in Canada and the US, but how did this all evolve for you to end up coming back here in Canada and run this commercial company?
It's a long story. Growing up here, with family, only boy, youngest, single parent, living in Ontario housing, migrated from Jamaica, the whole thing. Went to high school, public school, high school here, went to Eastwood. I went to Conestoga College here, and then ultimately moved to Toronto. After I started brokering here, moved to Toronto, and was always thirsting for more challenges. And I always wanted to challenge myself and hold myself accountable for adding value. So continued to look for opportunities, ultimately ended up in the U.S. after I left brokering completely. And that was interesting. The U.S. market, especially in some of the large cities, can be very interesting. Moving from Toronto to San Francisco at the height of the dot-com boom, which is where I was in 2000, that was tremendously interesting. I was there for a couple of years, and moving from San Francisco to Atlanta, two completely different cities in terms of their their culture, their geography, their weather, all of that. So getting used to some of that was interesting. And it's interesting, the information and the knowledge that you gain along the way and the people that you worked with. I've had such good fortune to have worked with so many incredibly smart people that I've been so thankful to have been able to draw information of both kind of tangible information and intangible information in terms of how they work, their work style, and commitment to executing on a project and on delivering value for clients. So you see a lot of that stuff, and you kind of take that on, and then you position yourself and you hold yourself accountable for different opportunities as they come up. And my wife, when we left Atlanta and moved back home, there was lots of opportunities, and throwing your hat in the ring, and you come home, and it's great to come home and be able to take on larger roles than perhaps you maybe would have thought would have been available when you left. But it's, again, because you've done some things in the States and you've added some value, and people see value in that when you come back. And career path is interesting. And I've definitely not had the typical career path. I don't even know what the typical career path for many of us is anymore. Right?
Exactly. Yeah, it's so diversified now.
Well, it is, and you have to be able to handle different opportunities as they come up and be nimble and be challenged, but want to be challenged and want to be, that whole A word, the accountability word, is something that if you want to be successful, if you want to progress, you have to look yourself in the mirror and hold yourself accountable for wanting to achieve and wanting to continue to achieve, not just for yourself, but ideally for your clients and your partners, in my case, for my referral sources and for the clients, right? Because for every deal that we get, we have two clients, the referral source, as well as the end user client that's borrowing the money. And so we hold ourselves accountable to make sure that we can execute and add value for those. So it's I don't know if I answered your question, but it's there's just a lot of
you've had a lot.
There's just a lot of moving parts to and it's never over, because there's always, our business is very transactional, so there continues to be lots of opportunities, and you could work on a deal I've worked on a deal for a couple of years in some cases.
And that's where I think the commercial space is so interesting, because coming from the brokerage side, and again, we do mostly residential and we refer off to you for commercial, is because it does take a lot of time. It's very extensive. The educational piece, I feel, in the commercial, there's so many layers to it, and it's hard as a broker to be able to pivot and do both very, very well. And that's why partnering with someone like yourself and your company, you're able to give that exceptional experience to the client and also be able to educate us, right? So that as brokers, we're giving the proper information to guide the clients to be able to utilize your services. But not everybody can do commercial financing. It's like you said, it's not only a long road in terms of seeing the end game on it, but from a financial perspective, there's not a lot of recoup on that in a quick manner. It could take, a year, or you tell me, it could take more, right, to get that completed.
Dozens of hours on a successful transaction. Yeah. Dozens and dozens and dozens of hours on a successful transaction. And that's for somebody that does this day in, day out, understands what they're doing, understands the lender audiences, understands the whole process, where deals should go and why they should end up there, understands how to hold a client's hand, particularly for those clients that are just buying their first asset, explaining to them what's involved, rates, timing. And it's interesting, and you know this as well as I do, because you'll have a client and they'll go down the road of starting to give you what their potential deal profile will be, and you'll automatically know which lender potentially this deal should be going to. So if a client calls me and says, hey, I'm looking to buy this motel in Collingwood, you automatically start shifting your brain to an area where, okay, these are the lines of questions I've got to ask them. If I'm going to buy a campground or a private school, I'm financing this not campground, but a private school in Collingwood. So you know the types of questions that a lender's going to ask. You know how this deal needs to be structured, and we see so much stuff, that's kind of the fun part of our business. There's never a dull day, right? Because
it's always something new.
There's always something new. There's always something, and for people, this is special for them. Just like a house is special, critically special for somebody. For someone that's looking to make an investment, if it's an investment property for them, or if it's owner occupied, in other words, they're going to buy something to operate their business in. It's critically special for them, right? This is their livelihood in some cases, or in many cases. So getting in there and being able to support them and understand, what their short-term, mid-term, and long-term objectives are of wanting to do this, and then kind of getting through how you can support them in this journey. It's actually really cool. It's very rewarding, and you actually, like you do in your business, you end up owning part of helping them be successful.
Exactly.
And it's pretty cool when you walk away and you get a guy that drove back from Belleville to give you a bottle of scotch to say thank you, because they were declined at a couple of different places and we got them institutional financing. And that was a whole unique deal on its own. But you just do a lot of these things, and it's pretty cool when you can add value and you see a company that you've helped to reposition, and now they're kind of, the wings are
They're going. And it's nice because you're helping create a life for them and their families and support other people in the community. We're getting right into where I thought maybe we would get later on about commercial financing, but I think it's timely because you and I talked, there's so many layers to this. I'm going to have you on more because there's so many different niches out in the marketplace right now that people are looking at. Commercial financing, that word is so broad, and the definition, I think there's a multitude of explanations and layers to it. But I really want to take it down to the simplistic piece of what commercial financing is, because for a lot of listeners, they may not understand that. They may be just a homeowner, which is completely fine where most of us are at, and not necessarily diving into the commercial space. Can you break that down? Very simple. What is commercial financing?
So commercial financing is a comprehensive term that would include commercial mortgages. But commercial financing could include business loans. It could include things like what we call asset-based lending, equipment finance. It could be a whole variety of different things. Our specialty is commercial real estate finance. What I say to people that aren't familiar with it, especially early on in a call, if someone refers them to me and say, hey, I want to buy this $2 million commercial property, I want to find out if I could buy it, if I could afford it, does it make sense? And so I'll kind of walk them through how lenders will qualify, what the commercial real estate financing process is all about, what are rates, what kind of terms are there, what costs are involved, how long is this going to take me? Should I even do this? Does it make sense for me? Does it make sense? How much money am I going to have to come up with? Does any of this make any sense? So kind of walking them through, and we end up getting very, very prescriptive for people that have never done this before, because it's important by the time they hang up in that initial call, for them to go, okay, I'm not an expert, but I got a really good tutorial of what this is all about and why I think I should do it or why I think maybe I shouldn't do it. And I'll give them unfettered feedback about why this may not necessarily be a good idea for them based on what I know of their situation. And if they tell me initially in the call what their short-term, mid-term, and long-term objectives are, and then by the end of the call, if what I'm getting from them and the numbers don't necessarily align, then I'll tell them. Because I can be unemotional about things like that versus somebody that says, I want to buy this property because it's close to where my uncle and my aunt are, and I could locate the business in there, and I could rent out upstairs. And sometimes it just doesn't make sense for them.
With the trends that are going on right now, and people are looking at different ways to be able to earn income or maybe change their career path, because let's face it, inflation's been high. It's hard for people to manage their money right now. And they might be looking at their place of employment saying, okay, maybe I need to take that leap of entrepreneurship. I need to get into having a business, owning a commercial space. How do you have people start that? What is the first thing? Because a lot of people they'll call me and they'll say, oh, I want to buy this commercial space and start this building. And they haven't done anything. They haven't done any prep work. What would you recommend people do for the foundational steps?
So you can do a little bit of research online, but reaching out as early as you can in the process to somebody that's a professional in the space, someone like ourselves or someone else that's got some knowledge, so that you can have that initial conversation, because that initial conversation will save you a lot of time and headache, right? Understanding how lenders will qualify you, because in our space, it's all about two things: cash flow and debt service, right? And this comes up a lot in that initial call with somebody. Having people understand how lenders will qualify, because that's a critical thing. Am I going to be qualified? Because if I'm not going to be qualified, then it doesn't make sense me taking some time. Right? If we do all the math, and in commercial real estate, the general rule of thumb is the property is supposed to stand alone and service its own debt if it's going to be for an investment perspective. And if we do the numbers and it says that you're going to have to put down 50%, then that's a hard conversation we're going to have. Does it make sense, Mr. Smith, that you put down 50% on this property because your returns are going to be really low? I'm not sure this is probably the hill you want to proverbially die on, so to speak. Is this the highest and best use of your capital to put into this property to get a decent return? A lot of times the answer is no, and I have to kind of nudge people away from certain things. But it's quantitatively driven. It's not a qualitative decision, right? It's like the numbers don't lie. Sometimes it's you really have to kind of tell people that But it all starts with education and getting in front of the right resource that'll help you make an informed decision about an investment.
Credit has a big indication too of what you qualify for, just like it would be on the residential side.
It does. It's interesting because in the commercial space, credit is one of the boxes to be ticked.
Okay.
So yeah, if you've got judgments and collections, it's going to be hard to get a credit decision in your favor, ideally in your favor on the residential side or the commercial side. But on the commercial side, there's so many more boxes to be ticked because, again, the lender's so focused on the asset itself. And again, specifically if it's going to be an investment property. And in our space, there's investment properties and then there's owner-occupied properties. Owner-occupied properties are really more focused on analyzing the operating company that's going to be making the payments, right? Which is the business. So if you own the business, you want to buy a building and operate out of there, it's considered owner-occupied. So then we're going to do all the analysis and figure out, okay, can your company afford to make the payments for this building? You end up being your own landlord. And then again, we'll walk you through logical things like setting up a separate holdco to own the business and you pay rent to the holdco. It's a whole other separate conversation. But on the investment side, if you're going to buy a 6-plex or a 12-plex or something, we need to do the math to figure out how much leverage the property can qualify for based on the net income that it throws off. And so going through all that analysis, again, it ends up being, as you had said, very quantitative, right? Because the numbers will dictate and tell you, because there are certain thresholds that we have to meet from a lender's perspective. Every dollar of debt, lenders want to see $1.25 in net income, right? And how we get to all that maybe is a story for another day. But when we do the math, if we can't get to that 1.25 to 1-ish ratio, then we need to make some adjustments to the point that we can get there. But with that adjustment comes, you may have to put down a bunch more money, Mr. Smith, in order for us to get down to that service coverage threshold.
So let's talk about that because I think a lot of listeners and people who have talked to me don't understand debt to income ratio. Can you explain that?
So how a lender will qualify, and in your world, it's in the residential world, it's gross debt service, total debt service, right? In our world, it's debt coverage ratio, DCR. So if you're looking at an investment property, essentially what lenders want us to do, how we qualify an investment property is we add up, let's just say there's a 12-plex someone's buying. We add up all the rents, all the income from all the units. We subtract the expenses. We have to add in things like vacancy and management, et cetera. And we subtract insurance and all that kind of stuff. We subtract all the expenses and we come up with something called NOI, net operating income. Essentially what's left over to make a mortgage payment after you deduct the expenses. So intuitively, it kind of makes sense, right? So we take that NOI, and essentially that goes into our numerator because that needs to be, going back to that ratio that I mentioned before, that needs to be 1.25 times our annual debt. So annual income from the asset needs to be 125% of the annual debt. So there's going to have to be cash flow. Lenders don't want to ever be lending in a break-even environment. There has to be excess cash flow. So hopefully in that case, objectives and your objectives are aligned because lenders want to see cash flow, and hopefully you're investing because you want to see cash flow as well. But lenders have, generally speaking, that threshold that they want to see. So, but we have to walk through that with the client. So that's essentially how lenders will qualify a property, high level. Now, if you're buying a retail plaza, there may be vacancies. So what do we do there? Some of those vacancies are going to impact our ability to qualify because we can't count on those units. We can't count cash flow where there's no cash flow. Similarly, if it's a commercial property like a retail plaza and we look at the rent roll, which is a list of all the tenants and when they started, what they're paying, square footage, all that kind of stuff, and all the leases are short-term leases, right? That's a problem, right? If you're going to buy a unit or a retail plaza with 10 units in it and a lot of the leases, half the leases are due in a year from now and there's no annual renewals to those leases, and we may have to look at discounting some of that cash flow, which will then impact our NOI and our available potential leverage to get. So we really have to dig into, this is kind of where our hands end up getting pretty dirty, digging into leases and all that kind of stuff just to make sure that we're properly qualifying the client, properly qualifying the deal and the asset.
And what you're just saying there, what's going through my mind right now is it's a lot of time, it's a lot of documentation. So when people are coming to see you, they really have to make sure that they have the proper documentation to know what their numbers are. So let's talk about someone coming to you with, that question of, should I buy this commercial building? What documentation should they have for you at that point?
So generally some standard documentation. Usually if they're working with a commercial realtor, which is ideal, they're going to want to have listing, income and expense information. Again, if it's if it's investment or if it's for owner occupied. Listing is fine if it's owner occupied. Obviously an APS, agreement of purchase and sale, but generally speaking, a listing's fine because usually they're going to have a lot of the relevant information on the listing that we'll need. If it's an investment property, sometimes we'll need a little bit more information. But a lot of times if it's a commercial real estate agent and they're actively marketing the property, they're going to provide you with as much information about the asset as they can because they want to sell it. And then, of course, if it's owner occupied and they're going to be moving their building in there, then as I mentioned before, we're going to be asking a lot of information about their operating company, financial statements and corporate NOAs and T2s and all that kind of stuff, as well as personal net worth statement and things more specific to themselves personally. Commercial lenders are really underwriting two things, the asset and then the covenant. Covenant being yourself and your company. A lot of times we encourage people to set up holding companies to own the real estate, even if it's a standalone, your first 12plex. You should set up, don't buy it personally. It's not recommended. Not going to give people tax or risk advice. They should see their accountant or the lawyer for some of this stuff. But what we've seen the most successful people do is set up a holding company, ideally single asset holding company to hold it. Right? There's 12 people in your 12plex. Someone falls down, hits their head. If you've got 15 or 20 properties in there, they could go after the income that's inside that holding company if it has a whole bunch of other assets. So we encourage people to set up individual holdcos to own assets. Again, some of the things that we'll go through when we're qualifying the property, just as an FY, because sometimes if they come to us, they may not necessarily have seen their accountant, but we'll reinforce, hey, these are some of the takeaways that maybe you need to do. But when they come to us initially, listing, personal covenant information is fine. A lot of times when they come to us, they don't necessarily have any of that information, which is okay as long as they can tell me a story about what their objectives are, what they're targeting. And then after the phone call, we typically will follow up with an email and reiterate a lot of the discussion that we've had. And I'll kind of put that in writing. So then it's a stake in the ground for me as well, because I'll know what we discussed and generally speaking, what we quoted based on the information that we had. So I've got a marker for the conversation as well. So, and plus it's good for me to re-articulate what we talked about in our conversation, because a lot of people want to share that information with spouses or partners that weren't on the call. So it's good.
And it's good for them to look back. So that whole process, just in a general idea, how long does that take from front to back to like them talking to you, application, vetting out different strategies to actually the approval?
Forever. So the average transaction will take 3 months. Again, that's the average transaction. Nowadays, there's no such thing as an average transaction. But in the case of a purchase that's date certain, in other words, there's a date on, December the 13th when they got to be closing that property, then we have to make sure that we engage and we push our lender partners and we push, frankly, the client to make sure they get us documents on a timely basis. So if it's a refinance, then, the date certain is not really there. It becomes a little bit more squishy, if you will. But we still want to get it expedited and move the deal along. So it really depends on, if it's not a purchase, then it could be 3 months, 6 months, some cases a year or even years. We've worked on deals where it's just, I've celebrated birthdays, right? Which is not ideal, but, it's kind of the case where, transactions kind of take on a life of their own. And in some cases, it's just not the client's fault. It's just the nature of the beast. In some cases, it is the client's fault. And you still have to roll with that.
Well, I always say to people, we're as good as the documents we get. So it's better to make sure you're prepared. And I love the fact that you went through some of the documents. I know it's not all, but some of what people are required. But this is why, and I think it's one thing I want to touch on, is when there is offer to purchases in place, obviously you're dealing with a commercial realtor, but it's really important that they also understand the timeline cannot be quick. It's not like a residential mortgage or purchase where it's closing within 30 to 45 days. We can do that. We're talking a few months because financing realistically isn't necessarily solidified within 2-3 months, right?
No, it's not. And I'm smiling as you're talking because we've done talks before at residential real estate companies just to help some of the realtors that are on the residential side just get a little bit more familiar with this commercial space. Because if I had a nickel for every time I saw, 15 banking days in a residential APS, right, for a commercial asset. And it's unfortunate, but they've created expectations that just aren't realistic because they just don't know. And that's fine. None of us knew a whole lot of stuff until such time as we did. Got to learn. It will take typically to get financing. And people will ask me, well, what kind of financing conditions should I put in my APS, in my offer to purchase, or my agreement to purchase and sell. And 45 to 60 days is what I would typically recommend. And that's not closing time. That's just the time to allow for financing. You ask, well, why is it so long? And the reason why is the commercial financing process, frankly, is old and inefficient, unfortunately. Unfortunately, the deal that we get in from you, Mr. Smith, is not going to be the first deal and the only deal on the lender's list, unfortunately. Not dissimilar to your world. Number one. Number two, things like a commercial appraisal from an AACI designated appraiser may take in this market 3, 4, 5 weeks in some cases. It doesn't happen in a matter of days, right? So from the time that we put the report in, or the request for the report, to the time that we actually get the report, it could be a month, right? And so there's the preliminary part of underwriting a deal. And in our world, lenders just don't go from application submission right to commitment. There's a term sheet or an LOI that's in place, which is really a lender's expression of interest, right? We got to sign off on all that, agree to that. Then they pick up their pen, and then they start committing resources to the deal. And then there's a point at which between term sheet and commitment that they'll put their pens down and wait for that appraisal, right? Because gone are the days in our world where a lender would give you a commitment subject to an appraisal. Now, all the information's got to be in before they actually give you a physical commitment. So it takes a long time to get stuff done, which is why I said we will spend dozens and dozens and dozens of hours over that average time of, say, 90-ish days that'll take a deal from start to funding to get a deal done, because we're picking up the file, we're putting it down, we're calling you back to ask for some information that the lenders just asked for. We're waiting for information to come in from your accountant because maybe they're on holidays or something. And then we may have to get an environmental report, maybe a building condition report, something. And again, every deal has its own uniqueness, so it takes a while.
And you mentioned something about AACI appraiser. Could you elaborate on that? Because a lot of listeners won't understand what that is.
Yeah, so in the residential world, there's a CRA, and that's a designation primarily for appraisers that focus on residential real estate. AACI, that's a commercial designation, Credit Appraiser of the Canadian Institute. That's what it stands for, and they focus on commercial real estate appraisals. And part of the reason why it takes so long to get commercial appraisal is there's just a whole lot more work that's involved. You've got to look at different types of comps, just the structure of it. If you look through a commercial appraisal, if you can stay awake long enough to get through the whole report, because
it's very long.
It's very long, very detailed, and it has to be very long because if Mars ever hits Earth and a lender who's relying on this appraisal ends up having to go to court because something crazy's happened in the deal, they have to be able to put up their hands and say, hey, I stand behind the data in this report that I gave to that lender at X point in time. And every lender, just like in the case of a residential file, has to have a letter of authorization, letter of transmittal, or reliance letter addressing that appraisal to that lender that authorizes them to use the report and the data therein. You know, if you're going to put your designation on the line and your data on the line as a professional, there's a whole lot of work that goes in there, right? And a lot of lenders are relying on that report. And you know, one of the things I'll also mention is, again, not dissimilar to the residential side of things, not every appraiser is approved by every lender. Every lender has an approved list of who they want and who they don't like. And so it's always best to make sure that that if you're going to proceed, that you know, you're working with a professional that knows who's approved and who's not.
And also someone that is going to look at their file, right? Like that, you just said, it's speaking to you before that's even done.
Right. That's so far down the line.
Exactly.
You know, because I've had people that come to me and say, listen, I've got an appraisal. I look at the appraisal and I just know that's, you know, out of respect, he or she has an AACI designation, but is probably not on the lion's share of lenders that
accept it.
That would accept it. And when a client comes to us, we typically may go to 3 to 5 different institutions on a deal, depending upon the asset itself and where it is, et cetera. But that's kind of the typical audience that we would distribute a deal to after we put our submission and our package together.
And that appraisal is not cheap. So it's not like residential. It's a lot more expensive. So what are we looking at for price range?
Thousands of dollars. Yeah. When I say thousands, it could be, you know, for a mixed-use property in a town, it could be several $1,000s. You know, for a larger commercial building, it could be $5,000 or $10,000. It really depends. But it's not $700. It's not $1,000. Right. It's usually going to be a few $1,000s or more. So understanding, and this is, you know, that will also come up in our conversation, right? So when I have a conversation with somebody initially, and I mentioned before that I'll send a follow-up email. Hey, Mr. Smith, good chatting with you. here's my understanding of what you're trying to achieve, right? Bunch of bullet points up there. And then I'll reiterate, what we verbally talked about based on what I know of what they're trying to do, what they're trying to buy. Okay, rates, ballpark indicative rates today will be such and such, of this than this. It all depends, of course, how you qualify, but I need to be able to give somebody something to digest in that initial call. So when they have to go, okay, I was expecting 3% rates. Well, no, there's no 3% money right now for commercial. It doesn't matter how good you are. Like it's just doesn't exist, right? The lender's cost of funds might be 3%. So you're not going to get it. So, and then also reiterating what rates are. And in commercial, there's typically 5 buckets of cost. Lender fees, because every commercial lender charges a fee, unlike on the residential side, right? Because it takes so long. Every commercial lender charges a fee. Banks, credit unions, insurance companies, and they charge an application fee, and they also charge annual review fee. So literally, the regulators force them to take the file out once a year and call it a light requalify, submit property taxes, insurance, financial statements from the holding company, all that stuff. And they charge you for that, right? And so part of our value add between negotiating the mortgage amount and the deal structure itself, we will negotiate the lender's application fee, the interest rate that you get, as well as things like the annual review fee upfront. So clients, and again, we tell clients all this upfront. We educate them saying these are all the costs that are involved, right? And again, I tell them that verbally on that initial call, and I put that in the follow-up email. And then lender fee, broker fee, because we charge a fee because we have to, unlike on the residential side where qualified brokers will get paid from the lender that you send the deal with in a lot of cases. In our world, lenders don't pay us. Not only do they not pay us, they themselves charge fees, as I mentioned. Lender fee, broker fee, legal fees, 2 lawyers on a commercial file. That's just the way that it is. And the client pays for both. Appraisals, as I mentioned before, things like environmental. So there's like literally 5 buckets of costs. So walking clients through what's involved and then spending some time on the costs so that they're going into the transaction with both eyes open is a big deal.
Well, for sure, because you just said there's so many costs that are involved, so people need to know. I want to get into what type of properties that you finance, so people really have an idea we know the definition now of what is commercial, but talk to me about what you've seen recently and what you financed.
A mixed bag, everything from hotels, motels, campgrounds, and other recreational properties. Some people say, you know what, I'm going to sail into my retirement years operating a campground with cottages by a lake because they like that. So we finance those, financed private schools before, medical office, a lot of apartment buildings as well, mixed-use properties. There's not much that we haven't seen. I've even seen a hangar-minium. You know what hangar-minium is?
No, what's that?
Think about that.
Hangar-minium.
So it's like a condominium up top, and you pull your private plane in down below.
Oh, my God.
Right. I hadn't seen one of those before.
Where's that?
You can find them. They're not around very often. That was the first time I'd seen one. This is going back a few years. So the point is there's not much that we haven't seen. We see land, you name it, marinas, you name it.
Okay, so when you say land, will you do land loans for people to build?
Correct.
Commercial. Okay, so that's interesting. And yeah, we could go and dive into a whole bunch of stuff on that because that is, I find, quite common right now.
It is, but not a lot of land lenders are showing up to that party.
No, I know.
No.
I know.
It's then because a lot of them are still funded on land that they've not been able to get refinanced, right? Because they still have exposure to old loans that they haven't been able to get refinanced out of because it never got developed.
And that's one of the biggest things. Let's talk about the market today. What are you seeing? Let's talk about what you're seeing from what people are coming to you for opportunities in terms of the commercial space right now.
So again, it'll vary between owner-occupied and investment. On the owner-occupied space, we get a mixed bag of stuff a lot of times at commercial or industrial property or unit or something like that because somebody wants to move their medical practice in there or they want to move their factory in from a lot of people that are buying owner-occupied businesses, it's because they were renting before and their long-term lease is coming due. And in fairness to their landlord, the rent's gone from here to here because the landlord needs to get paid as well. Rents are below market, so why shouldn't they get paid? So the rents are getting bumped. And then so some people are doing that calculation and say, well, geez, should I continue to rent here or I'm just going to go buy my own self and pay myself, which makes all kinds of sense. Enter me or somebody like me that says, okay, in theory it makes sense, but does it though? Because you need X number of equity to put into this property and you need some financial statements that look good. And it's always a challenge that until someone comes to someone like me, a lot of people just don't want to pay taxes. right? So their financials aren't necessarily the prettiest. So then we have to have some hard conversations around, yeah, it might be a good idea to look at a commercial property, but it may not be a good idea for you to buy it at this point because these are the reasons why. So come back to me when X, Y, and Z looks a little bit differently. So it really depends on how the financial statements look. So we're still doing lots of owner-occupied because there's lots of people whose rents are coming due, whose leases are coming due, and they figure, okay, I'm just going to buy something. On the investment side, lots of people are looking in the multi-residential space. So in the commercial world, there's 4 different asset classes: multi-res, apartment buildings, industrial, retail, and office. That's what we call the 4 commercial food groups, as we call it. And so multi-residential and industrial have been the hottest asset classes in recent years. Retail is still trying to figure itself out kind of post-COVID, but it's coming back. Office is still trying to figure itself out, as a lot of us know. Industrials, it was really hot. It's kind of flattening out a little bit now, but I think it's still hanging out. But a lot of people have been really so focused in multi-res, particularly now that the condo market's kind of stalled. Stalled is an understatement. So multi-res is a hot one. So lots of people coming to say, hey, I want to buy my first 6-plex, my first 8-plex, my first 12-plex, that kind of stuff. So lots of opportunity there. But I'll tell you that we've probably, I bet you 40% of our business in the last number of years has been in the owner-occupied space, because a lot of people's leases are coming due and they don't want to pay rent to the landlord anymore. They want to own their own asset. And frankly, that's kind of their exit for their business down the road, because a lot of people say, well, if I own the real estate, I can sell my company and then keep the real estate, right?
Yeah.
And as an investment. So, and I can will that into my kids and so on and so forth. So a lot of people that own businesses are really looking at buying the real estate, running it, because I got to live somewhere. My business has to reside or live somewhere, and then just own the buildings and the wall, and I can just keep it and rent it out to someone else down the line.
Are you finding that, and on that note, are you finding that people that are looking to do that are doing these conversions? There's a lot of media out there and noise about people converting properties or tearing them right down and building 6-plexes or 8-plexes, and we're seeing a lot of rezoning of different cities, Toronto, Kitchener, in between. Because, the municipalities and the government knows we have to build up and not out. It's very hard to do that. Are you finding that a lot of people are coming to you with those type of conversations?
We are getting some of those conversations. Yeah. That ends up being a very capital intensive situation. If you're talking about development, a lot of moving parts there. In situations like that, usually it's not their first rodeo.
Yeah.
Usually, if you're going to buy something, explaining to somebody, because you have to have the capital to acquire the property and carry it, then reconstruct it and develop it, ends up being a fairly long story. And so we're certainly happy to support people in that situation, but usually that doesn't tend to be the first-time buyer that's going to do that. But yeah, we see those deals all the time, and there's more and more of that right now. I think that business is stalled a little bit, just development. And lenders, because even the lender's appetite for risk in that area, that bar has been raised, right? So because they're having some issues in their portfolio with non-performance on some of those development loans. So now from a credit risk perspective, they're saying, okay, we're going to mark those a little harder when they come through the door now, because we have to.
Are you finding that they're not getting completed because of what's going on with tariffs and the lack of, or the costs of just supply of being able to retrofit a lot of these buildings from the materials of we're looking at steel and aluminum and what's going on this year? Do you think that's a lot to do with it? So
I think down the line that may have some more impact, because I think it's still early. That's kind of got to work its way through the process, I think, a little bit. But if you're looking at a pro forma, which is really where everything starts, right? If you're going to look at development, the pro forma ends up being hopefully a number of years in advance, or a year, depends on how big the project is, years in advance, and you're going to have to put in the cost of drywall and steel and all these other things. And at some point, it no longer makes sense the closer you get to the project reality and reworking your numbers. So that's not necessarily the issue right now. I think the issue is trying to find projects that actually make sense, because a lot of developers will tell you things just don't pencil out right now, right? Between land cost, labor cost, both the timing and the cost to get stuff through all the government processes and all the money you got to pay to the government to get things zoned and so on and so forth. All the fees involved there, it doesn't work. I was at the Land and Development Conference, try to go to those every year, and those are interesting. You end up with a receiver. One panel it's about condominiums under in receivership. And this is kind of cool. Let's go to that one. And you end up with a receiver and a lender and a developer on a panel, It's fascinating to see the number of units, or to hear about the number of units that are in receivership and how many more are coming. So the condo market is in a bit of a funk, and it'll probably be in a funk for a number of years now because there's so much backup of the number of units that are inventory that are finished and still yet to come.
A lot, right?
It's a lot. It's years and years and years of it.
I heard it's something like 40,000 units that are coming up in the GTA alone.
Yeah, and and that's just like, and there's so many other, like the big developers that could afford to sit on developments for years, right? Because they're not really carrying huge amounts of debt. We're just obviously going to pick up, some of these other projects that are stalled or in receivership. But the big folks themselves, they've got a ton of other projects that they're sitting on that they know they can't bring, that don't pencil out. So they're not bringing it to the market as well, but they're probably just going to push those back and just kind of pick off the stuff that is in receivership that's struggling, that the banks can't get paid out, or private lenders can't get paid out, and they'll finish them off either now or at some other point. It's the condo market is a whole different conversation, but yeah, we see a lot of stuff that comes to us on the development side, and there's a whole bunch of reasons why they'll stall. Like the city's taken some time to get stuff through, and that's some developers didn't see that coming, so they've had to carry projects and interest costs, and so they run out of paper. Their powder runs out, and they're looking around saying, okay, well now it's I got to sell my house, because the lender collateralized their home, right? Because the land wasn't good anyway. So we see all kinds of
it's complex right now. So tell me, Mark, where do you see commercial real estate in the next 12 months?
I think there's still opportunities out there. I think it depends on. Depends on who I'm talking to. If someone says to me, hey, listen, I'm looking to invest in the market, where do you see commercial real estate? Well, it really depends on, what's your appetite? Which geography are you in? Do you have a particular asset class that you're interested in? Because my answer might be different for each one of those, right? So, looking at what's happening with downtown office or suburban office, probably not the first place, the first-time investor who wants to go. Right. But we see first-time investors looking at 6-plex, 10-plex, 12-plex. A lot of time it's ends up being outside of their home market in a smaller market just because acquisition costs tend to be less expensive. A quick story. We did a deal for a couple of brothers. They're police officers in Hamilton. And they each owned 4 or 5 condos and a couple of semis and had them for a while. And they said, we're going to sell all this stuff. We want to buy an apartment building. Their first multi-res purchase. They're in and around the Hamilton area. So they started looking out, the search circle kept getting bigger and bigger. They started looking Barrie, Sault Ste. Marie, Windsor, Belleville. They ended up buying a 43-unit building in Moncton, New Brunswick. St. John, New Brunswick. Yeah, because out there, this is a number of years ago, there isn't rent control out there like there is here. Yeah. I think it's kind of come in a little bit, but it's still not the same as it is here. And the acquisition cost out there was just far below what they could have gotten for here. And we did a CMHC insured loan for them, 3.5%, 10-year term, 40-year amortization. And we've since come back and refinanced that for them so they could buy another building out there. But in that case, the reason for that story is if someone asks me that question, it kind of really depends. And so those guys were looking for multi-res, and that's where they focused on. And that's frankly where the biggest opportunity has been out of all the asset classes right now. Again, unless you're looking for owner-occupied stuff. Right. So
I think what you're saying is that the opportunity is still out there.
100%.
And I think that's the great thing, that as much as there's challenges out there, and commercial's so complicated, but there is opportunity. But speaking to an expert like yourself and your team to help people navigate what solutions or what way they need to pivot. And like you said, it's not just maybe a local thing to take a look at. It's within Canada. There might be some massive opportunity for you. And I think that's the best way to really end this segment, is to let people know that there is still opportunity, but you got to speak to experts. You have to have your team around you that can really support and help you navigate from documentation to the experts you need to do to be able to get you to that final goal of what it is, right? Mark, thank you so much. It's been a pleasure to have you on. We have a lot to talk about, and I'm definitely going to have you on again. We're going to be breaking down a lot of these different types of projects so that people can really understand commercial, because I think there's a lot of people that are very entrepreneurial in Canada and are looking at ways to be able to pivot on their income and look at ways to be able to grow their net worth and their assets. And real estate is still a great opportunity, but building that business within it, I think, is something that you can actually, and you do help a lot of Canadians too. So thank you so much. How do people get a hold hold of you if they want to connect with you?
Email mark@encompassfinancial.ca, mark@ncompass financial.ca. Feel free to drop me an email, and either myself or someone on my team can certainly help and support.
Yeah.
Happy to connect, and I appreciate this opportunity. Thanks very much, Tracy.
And to everyone tuning in, thank you so much for joining the conversation today. If you love today's episode, please make sure you click the subscribe button, share with your network, friends, or family. And until next time, support one another and stay connected to our amazing community.